The advantage of analyzing the individual signals from candlesticks allow you to get much more information based upon the type of signal that is created. A lot of people would say, "Oh, the Dow is up 29 points today." They don't. That doesn't really say anything. But the fact that you look at a candlestick chart and see that it's also a hammer type signal, and it bounced exactly off the 50-day moving average area, and your stochastics are getting into the oversold area, allows a candlestick investor to be prepared based upon the results of what we would expect off a hammer signal. A positive open would be a clear indication that the 50 was going to be acting as support. That same analysis can be applied to the NASDAQ chart that did a doji also, and it did a doji right here at the same level it supported before, and it looks like they basically came down and filled the gap. So positive open would pretty much tell us this trend may be hitting a support level and starting back up. But it would also indicate that if they opened lower tomorrow and started trading lower, that our trend was still moving down based upon the simple doji rule, that the price or the trend is usually going to move in the direction of how they move it after a doji. The candlestick patterns allow an investor to be in the right place at the right time, or in the direction of a trend with a high degree of probability, as we see in our recommendation on CLMT last week after we saw the bullish engulfing signal gap up. And notice what it's used for support. On Friday, it came right back down and touched the T line. Today, it traded higher out of this range, giving us a little J-hook pattern setup. So all this analysis allows a candlestick investor to kind of anticipate there's going to be more upside, potentially the same magnitude as this right here. And when the market direction overall isn't real clear, that gives a candlestick investor the opportunity, or at least the trading strategy, to say if we don't know what the overall market trend is, we should have probably both long and short positions in our portfolio. Our recommendation was to go short. We covered our short positions after the kicker signal, but as we saw, it failed here at the T line, and there's our bearish double doji type setup, or a bearish trend kicker. And when it gapped down through this level, we knew we were in the right direction, that if this is wave 1, wave 3 for Under Armour may be in the same magnitude. Will it get down into this area? Have no idea, because our main criteria for staying short is we want to stay short until we see a candlestick reversal signal. Remember, candlestick analysis is merely the graphic analysis of what happens in human nature time after time, with the Japanese rice traders illustrating what signals tell us there's going to be a reversal, and how we can stay in a trend until we see that reversal. That'll be it. We'll see you in the chat rooms.